There's a raft moving down a stretch of whitewater on the Colorado River, and the young man guiding it has no idea that the passenger sitting quietly near the bow is about to change the entire direction of his life. He's 21 years old, broke, living paycheck to paycheck on tips from tourists. With exactly $1,000 to his name and a mountain of debt he has no realistic plan for paying off. He dropped out of college, drifted through a series of odd jobs, and eventually found himself guiding rafts through some of the most dangerous whitewater in the country, a job that paid him just enough to survive, with nothing left over at the end of any given month. Town describes the specific financial pressure hanging over him during this period, in fairly stark terms, owing considerably more than he earned in an entire year of guiding, with creditors calling regularly and no clear path forward beyond simply continuing to work the same seasonal job indefinitely, hoping the debt somehow eventually resolved itself. He'd genuinely never given serious thought to investing at all before that specific river trip, viewing the entire subject as something reserved for people who already had money to spare, a category he was quite certain he'd never belong to. He spent the summer paddling wealthy clients through rapids, watching people who clearly had money to spare pass through his raft, trip after trip, never once imagining he might have anything meaningful to learn from them beyond a decent tip at the end of the day. Then one particular passenger starts asking him questions, gently, patiently, about what he actually wants out of life and about how he currently thinks about money. The young guide answers honestly, admitting he doesn't really think about money at all, beyond simply trying to have enough of it to get through the week. That passenger turns out to be a serious, accomplished investor, someone who had built genuine wealth by understanding something most people never bother learning properly. And over the following days on the river, between rapids, around the campfire, he starts teaching this broke river guide the actual mechanics of how ordinary people can learn to invest with real skill, rather than blind luck. Town describes those conversations as unlike anything he'd ever encountered in his own scattered, informal education up to that point. His mentor didn't talk about hot tips, or lucky breaks, or exciting stories about doubling your money overnight. He talked patiently, methodically, about how to evaluate an actual business, how to think about risk in a genuinely disciplined way, and about a specific philosophy borrowed from some of the most successful investors in modern history, one built around minimizing the chance of a serious, permanent loss before ever worrying about maximizing potential gain. One specific moment from that trip stuck with Town for the rest of his life, a conversation held during a calm stretch of river between two sets of rapids, where his mentor asked him a simple, direct question. What would happen to his own life if he lost every single dollar he currently had? Town, having essentially nothing to lose in the first place, answered honestly that very little would actually change. His mentor then asked a second, considerably more pointed question. What would it take to build something genuinely worth protecting, worth structuring an entire disciplined approach around never losing? That specific reframing, from a young man with nothing to protect towards someone beginning to imagine a future genuinely worth safeguarding, planted the seed for everything that followed over the subsequent 5 years. That young river guide's name is Phil Town, and within 5 years of that conversation, he had taken his original $1,000 and turned it into more than $1 million. He didn't do it through some exotic trading scheme or a lucky bet on a single stock that happened to take off. He did it by learning carefully and systematically a specific set of principles that he later distilled into a single book, one built around a rule so simple it sounds almost too obvious to matter, and yet a rule that an enormous number of investors violate constantly, usually without ever realizing it. That book is Rule Number 1, and the rule itself, borrowed directly from one of the most successful investors in modern history, is this: don't lose money. Stick with this one, because by the end, you're going to understand exactly what that deceptively simple rule actually requires in practice, a specific 4-part framework. Town built his entire fortune around, and a way of thinking about risk that runs completely counter to how most ordinary investors, and honestly most of Wall Street, actually operates. Let's start with that rule itself, because it deserves a moment of genuine unpacking before we go any further. The phrase comes originally from Warren Buffett, arguably the most successful investor of the modern era, who is often quoted describing his entire approach to investing in exactly two rules. Rule number 1, never lose money. Rule number 2, never forget. Rule number 1. Town describes first encountering this specific quote during those same conversations on the river, and admits it initially struck him as almost too simple to actually build an entire investment philosophy around precisely the reaction most people have when they first hear it. It sounded, on the surface, like the kind of vague, feel-good platitude that gets repeated often without ever actually shaping anyone's real, practical behavior. What changed Town's own view over the following years was watching again and again how many otherwise intelligent investors he encountered violated this simple principle, constantly chasing exciting stories, ignoring genuine warning signs, and repeatedly exposing themselves to exactly the kind of catastrophic avoidable loss the rule was specifically designed to prevent. On the surface, this sounds almost like a joke, an obviously impossible standard dressed up as serious advice. Every investor, no matter how skilled, experiences losses at some point. Individual stocks decline. Markets correct. Nobody, not even Buffett himself, has ever achieved a perfect record where literally nothing ever lost value. But Town argues and spends the opening portion of his book carefully explaining that this rule was never actually meant to be taken as a literal, absolute guarantee against ever experiencing a single down day in the market. It was meant as a description of mindset, a specific, disciplined way of approaching every single investment decision, one built around minimizing the risk of permanent, catastrophic loss, rather than chasing the highest possible potential gain without adequate regard for what could go wrong. Here's the distinction that matters most. There's a meaningful difference between a temporary decline in a stock's price, the ordinary expected volatility that comes with owning any real business over time, and a permanent, unrecoverable loss of capital. The kind that happens when you've bought a fundamentally bad business, paid too much for a fundamentally good one, or simply gambled on something you never actually understood in the first place. Town illustrates this distinction with a simple, memorable comparison. Imagine two investors, each watching their portfolio decline by 20% during a broad market downturn. The first investor owns shares in a handful of genuinely excellent, well-understood businesses purchased at a sensible price, businesses whose underlying earnings power and competitive position remain fundamentally intact despite the temporary market panic surrounding them. That decline, however uncomfortable in the moment, is temporary, a function of broad market sentiment rather than any actual deterioration in the businesses themselves, and it will very likely reverse itself as that sentiment eventually normalizes. The second investor owns shares in a fundamentally weak, poorly understood business, purchased purely on excitement or a hot tip, without any genuine underlying competitive advantage protecting it. That same 20% decline might never actually reverse itself at all, because the underlying business genuinely was overvalued or genuinely was as fragile as the falling price now suggests. Two investors, an identical 20% paper loss, and two entirely different underlying realities. Rule number 1, properly understood, isn't asking you to avoid every temporary dip. It's asking you to build your entire investing process specifically around avoiding that second, far more dangerous category, the permanent, unrecoverable loss that actually destroys long-term wealth. Town's own personal story illustrates exactly why this distinction mattered so much to him and why he built an entire investing philosophy specifically designed to protect against it. Before that river trip, he'd watched people around him treat investing as something close to gambling, chasing hot tips, buying whatever happened to be exciting at the moment, with no real framework for distinguishing a genuinely sound opportunity from an exciting story that happened to be dressed up as one. What his mentor taught him over the course of that summer and the years of continued study that followed was an entirely different approach, one built around 4 specific, sequential questions that, taken together, form the backbone of the entire book. He describes the specific discipline required to actually stick with this framework during his own earliest years applying it, admitting there were stretches of many months at a time when no stock he researched actually satisfied all 4 MEAs simultaneously, leaving him sitting on cash while watching other less disciplined acquaintances chase whatever exciting stock happened to be dominating conversation that particular season. He describes genuine moments of doubt during those early years, wondering whether his mentor's framework was simply too conservative, too demanding, to ever actually produce meaningful results within any reasonable time frame. What eventually convinced him to stay the course was a specific, patient reminder his mentor offered repeatedly throughout their ongoing correspondence, that the entire point of the framework was never speed, it was reliability. And reliability, compounded patiently over years rather than months, was precisely what eventually produced his own extraordinary 5-year result. Town calls this framework the 4 MEAs, and it's worth walking through each one in detail because together they represent a complete, structured process for evaluating any potential investment before ever committing real money to it. Before diving into each one individually, it's worth naming the overall shape of this framework directly, since it's easy to lose track of the bigger picture amid the specific details still ahead. Each of the 4 MEAs addresses a genuinely distinct kind of risk. Meaning protects against the risk of investing in something you don't actually understand well enough to judge soundly. Moat protects against the risk of a currently excellent business being easily copied or displaced by competitors. Management protects against the risk of an otherwise promising business being run by people who don't actually know how to deploy capital skillfully. And margin of safety protects against the simple, almost universal risk of overpaying, even for a genuinely wonderful business satisfying all 3 of the earlier tests. Only when all 4 risks have been addressed simultaneously, Town argues, does an investment genuinely satisfy rule number 1's demanding underlying standard. The first M stands for meaning, and it addresses a question Town insists comes before any actual financial analysis begins at all. Do you genuinely understand this specific business? And does it genuinely matter to you in some real personal way? Beyond simply hoping its stock price goes up. This isn't just a feel-good motivational suggestion tacked onto the front of a more serious analytical process. Town argues it serves a genuinely practical purpose. An investor who understands a business deeply and who cares about it for reasons beyond pure speculation is considerably more likely to actually do the sustained homework required to evaluate it properly, and considerably more likely to hold on to that investment with genuine conviction through the inevitable rough patches every real business experiences over time, rather than panicking and selling at exactly the wrong moment purely because a headline frightened them. He suggests a simple, practical exercise for testing whether a business genuinely satisfies this first M. Could you explain in plain, simple language exactly what this company does, how it actually makes money, and why its customers choose it over its competitors? If you find yourself relying on vague borrowed language, you don't fully understand yourself. Jargon picked up from an analyst report or a friend's confident recommendation, that's a signal the meaning test hasn't genuinely been satisfied yet, no matter how promising the stock might otherwise appear on paper. Town describes watching this exact failure play out repeatedly among beginning investors. He'd later go on to teach people who could recite an exciting stock's recent price performance in impressive detail, but who, when asked a simple, direct question about how the underlying company actually generated its revenue, had genuinely no clear answer at all. He considers this gap between knowing a stock's price history and genuinely understanding its underlying business. One of the most common and most dangerous blind spots among ordinary investors, precisely because it leaves them with no real foundation for judging whether a given price actually represents good value or for holding steady with genuine conviction once the inevitable rough patch eventually arrives. Town also encourages starting this search specifically within industries and products you already have some genuine first-hand familiarity with, echoing an idea that appears throughout a great deal of successful investing literature that your own ordinary daily life, your career, your hobbies, the products you personally use and trust often contain more genuine investing insight than an unfamiliar exotic industry you'd need to learn from scratch, no matter how exciting that unfamiliar industry's story might currently sound. He extends this same principle to a related practical piece of advice, suggesting new investors keep an ongoing, informal watch list of companies they encounter and genuinely admire through their own everyday experience, long before ever running any formal numerical analysis on them at all. A business you've quietly respected for years, whose products you trust, and whose customer experience you've personally found consistently excellent, already carries a meaningful head start on satisfying this first M. Compared to an unfamiliar name encountered for the first time purely through a stock screener or a financial news headline, Town introduces a specific practical writing exercise connected directly to this first M, encouraging investors to actually write out in a few clear paragraphs the complete story of any business they're seriously considering, covering what it sells, who its customers are, why those customers keep choosing it over alternatives, and where the business realistically stands in 5 or 10 years if its current trajectory continues. He considers this written exercise a genuinely useful diagnostic tool in its own right, since an investor who struggles to write this story clearly and confidently, filling the gaps with vague hedging or borrowed language rather than genuine specific understanding, has likely uncovered a business that doesn't yet satisfy the meaning requirement, no matter how attractive its stock price or its recent headlines might otherwise appear. He shares a specific example of this exercise from his own practice, describing how writing out the complete story of a business he was seriously considering revealed partway through the exercise a gap in his own understanding of exactly how the company's revenue actually broke down across its different product lines, a gap he might never have noticed simply reading the company's own polished annual report, but that became immediately obvious the moment he tried explaining it clearly from scratch in his own words. That specific gap sent him back to further research before ever committing capital, precisely the kind of discipline the entire meaning requirement is designed to enforce. Town connects this entire first M directly to a related concept popularized by other successful investors. The idea of a genuine circle of competence, a deliberately bounded set of industries and business types, an individual investor has taken the time to genuinely understand deeply, and outside of which that same investor should generally decline to invest at all, regardless of how attractive an outside opportunity might otherwise appear on paper. He argues that a disciplined investor's circle of competence naturally gradually expands over years of genuine study and first-hand experience, but that attempting to invest confidently outside that circle before it has genuinely expanded to include a new area represents one of the more common avoidable ways otherwise careful investors end up violating rule number 1 entirely, purchasing something they never actually understood well enough to judge soundly in the first place. He offers a specific, honest account of his own circle of competence, expanding gradually over the years following that original river conversation, describing industries he avoided entirely during his earliest years of investing, not because those industries lacked genuine opportunity, but because he hadn't yet done the sustained work required to understand them deeply enough to evaluate confidently. Only years later, after deliberately studying those specific industries in real depth, did he consider them genuinely within his own expanded circle, worth evaluating with the same confidence he'd already built in his original, more familiar areas. He offers a related, Practical piece of encouragement for readers who might feel their own current circle of competence is genuinely too narrow to identify many qualifying opportunities at all, pointing out that this circle is never meant to remain fixed permanently at whatever size it happens to be when someone first begins applying the framework. Deliberate, sustained study of a new industry, reading its trade publications, understanding its specific competitive dynamics, talking to people who genuinely work within it, gradually expands that circle over time in exactly the same way Town's own circle expanded across his career. The framework was never meant to restrict an investor permanently to whatever narrow set of industries they happen to understand on day one. It was meant to prevent an investor from confidently acting outside their circle before that circle had genuinely, honestly expanded to include the new area in question. The second M stands for moat, borrowing directly from a term popularized by Buffett himself, describing the durable competitive protection that shields a genuinely excellent business from being easily copied, undercut, or displaced by rivals. Town breaks this concept down into 5 specific, distinct types of moat, and it's worth understanding each one clearly, because recognizing which specific kind of moat a company has, if it genuinely has one at all, is one of the most important skills the entire book is built around developing. The first type is a brand moat, where customers are willing to pay a premium or remain reliably loyal, purely because of the trust and reputation a specific company's name has built up over years or decades. A genuine brand moat isn't simply a company that happens to be well known. It's a company whose name alone commands a measurable pricing advantage or customer loyalty that a functionally identical unbranded competitor genuinely couldn't replicate, no matter how much money that competitor spent trying. Town illustrates this with the example of certain consumer products, where a functionally near-identical version manufactured by an unknown competitor at a fraction of the price sits directly on the same store shelf and still fails to draw meaningful sales away from the trusted, established name beside it. That persistent willingness to pay more for the name alone, sustained consistently over years, is the actual test of a genuine brand moat, distinct from simple ordinary name recognition that doesn't actually translate into any measurable pricing power or loyalty at all. He offers a specific practical way of distinguishing genuine brand strength from mere familiarity, suggesting an investor check whether a company has actually been able to raise its prices steadily over time faster than general inflation, without losing meaningful market share to cheaper alternatives. A company that has repeatedly demonstrated this specific pricing power year after year has provided concrete, measurable evidence of a genuine brand moat, considerably more convincing than simply observing that a lot of people happen to recognize the company's name or logo. He also cautions against a common mistake, assuming that any well-known, widely recognized company automatically possesses a genuine brand moat simply because of its size and visibility. Plenty of large, familiar companies compete purely on price within commoditized industries, where customers switch freely between brands based purely on whichever option happens to be cheapest that particular week, despite widespread name recognition across the entire category. Genuine brand moats, Town insists, are considerably rarer than simple brand recognition and require the specific, measurable pricing power test described above before an investor should feel confident relying on this category at all. The second type is a secret moat, protection derived from patents, proprietary technology, or specialized expertise that competitors are legally or practically prevented from simply copying. Town is careful to note that this kind of moat, while often extremely powerful while it lasts, tends to have a specific foreseeable expiration date, particularly with patents, meaning an investor relying on this type of moat needs to pay careful attention to exactly how much protected time actually remains before that specific advantage disappears. He describes watching companies enjoy years of exceptional protected profitability purely on the strength of a single patented breakthrough, only to see their profit margins collapse rapidly the moment that specific patent finally expired and a wave of cheaper, functionally similar competitors flooded in almost overnight. This makes secret moats, in Town's assessment, genuinely valuable but considerably more time-limited and considerably more urgent to monitor closely than some of the other moat categories, which tend to remain durable for much longer, less predictable stretches of time. He recommends a specific practical habit for any investor relying on this particular moat type: actually tracking the specific expiration dates of a company's most commercially important patents or proprietary protections, treating that expiration date as a hard, known deadline that should meaningfully factor into both the sticker price calculation and the overall holding period for the investment. An investor who fails to track this specific detail risks being caught entirely off guard by a sudden severe decline in profitability that, in hindsight, was actually foreseeable years in advance, simply by checking publicly available patent filing records that most casual investors never think to consult at all. He contrasts this specifically against a company protected instead by deep accumulated specialized expertise rather than a formal patent, noting that this particular variant of the secret moat tends to be considerably more durable and less predictably time-limited, since accumulated institutional knowledge and specialized technical skill built up gradually over years of genuine practice is often considerably harder for a competitor to simply replicate on any predictable timeline compared to the fixed, legally defined expiration date that comes with a formal patent. He offers a specific way of distinguishing these two secret moat variants in practice, suggesting an investor check whether a company's competitive advantage rests primarily on a specific legally documented protection with a known expiration date, or on a broader, harder-to-pin-down accumulation of specialized know-how spread across an entire organization and its long-tenured employees. A single expiring patent represents a specific, identifiable risk with a known timeline. A broadly distributed accumulation of institutional expertise represents a genuinely different, generally more durable kind of protection, though one considerably harder to measure precisely, requiring an investor to rely more heavily on qualitative judgment about the company's overall culture and employee retention than on any single easily verifiable legal document. The third type is a toll moat, sometimes called a toll bridge, describing a company that occupies a uniquely necessary position within a broader industry, one that other businesses genuinely have no practical way of avoiding if they want to participate in that industry at all. Town describes this as one of the most powerful moats available, precisely because it doesn't depend on customer taste or loyalty at all. It depends on structural necessity, a position within an essential piece of infrastructure, or a critical, unavoidable checkpoint that an entire industry has to pass through regardless of any individual company's or customer's personal preference. He compares this specifically to an actual toll bridge spanning a river with no other reasonable crossing point available for miles in either direction. Every single traveler needing to cross that river, regardless of their own personal preferences or brand loyalties, has no genuine alternative but to pay whatever toll the bridge's owner sets. A business occupying an equivalent structural position within its own industry, some essential piece of infrastructure, licensing requirement, or unavoidable distribution choke point, enjoys a remarkably similar, remarkably durable form of pricing power. He offers a second illustration worth holding on to, describing a company controlling a genuinely essential piece of specialized testing or certification infrastructure that an entire industry's other participants were legally or practically required to use before their own products could reach market at all. Because every single competitor within that broader industry needed to pass through this same specific checkpoint, regardless of which particular product they were ultimately selling or which brand they represented. The company controlling that checkpoint enjoyed pricing power almost entirely insulated from ordinary competitive pressure, a genuinely rare and durable position Town considers among the most valuable moats available to any investor patient enough to identify one. He notes that toll moats of this kind, precisely because they're structurally rather than emotionally or habitually based, tend to be considerably more durable and considerably less vulnerable to shifting consumer tastes than brand moats, which can, in certain circumstances, erode gradually if a once beloved name simply falls out of fashion for reasons that have little to do with the underlying quality of the product itself. A genuine toll moat, by contrast, remains structurally necessary regardless of shifting consumer sentiment, which is precisely why Town encourages investors to weight this particular moat type especially highly whenever they're fortunate enough to genuinely identify one distinct from the more common but somewhat less durable brand and switching cost varieties. The fourth type is a switching cost moat, describing a business whose customers, once onboarded, face genuine friction, expense, or risk in switching to a competitor, even if that competitor's underlying product looks broadly similar on paper. This friction might be financial, technical, or simply a matter of accumulated habit and institutional familiarity, but the underlying effect is the same customers staying put, not necessarily because they love the product passionately, but because the genuine cost and hassle of switching away exceeds whatever marginal benefit a competitor might offer. Town points to businesses deeply embedded into their customers' own day-to-day operations, where an enormous amount of accumulated data, staff training, and interconnected systems would all need to be painstakingly rebuilt from scratch if a customer ever decided to switch providers. As a particularly strong illustration of this specific moat, the switching itself doesn't need to be technically impossible. It simply needs to be expensive and disruptive enough in practice that most customers, most of the time, choose to remain rather than endure that disruption purely to chase a marginally better alternative elsewhere. He offers a specific test for judging how genuinely strong a switching cost moat actually is in practice, suggesting an investor imagine themselves personally in the position of one of the company's own customers and honestly estimate how much time, money, and disruption would actually be required to switch to a competitor offering a broadly similar product. A switching cost that would require only a modest, easily tolerated inconvenience doesn't represent a particularly strong moat at all. A switching cost genuinely requiring months of retraining, significant financial expense, or meaningful operational risk represents something considerably more durable and more valuable, precisely the kind of moat Town encourages investors to actively seek out. He describes a specific illustration of just how powerful this particular moat type can become once genuinely entrenched, describing a business whose customers had built years of accumulated interconnected processes directly around that specific provider's own systems, to the point where even a competitor offering a meaningfully cheaper, arguably superior alternative product still struggled for years to win away a meaningful share of established customers, purely because the accumulated cost and risk of actually making the switch outweighed whatever marginal improvement the alternative genuinely offered. This specific dynamic, Town notes, can sometimes allow a company to maintain strong pricing power and customer retention even after its underlying product has arguably fallen somewhat behind newer alternatives, precisely because the switching cost itself, rather than ongoing product superiority, has become the primary force keeping customers in place. He adds an important caution alongside this observation, noting that a company relying too heavily on switching costs alone while allowing its underlying product quality to genuinely stagnate or decline relative to newer alternatives eventually risks a different kind of erosion, not from customers switching away immediately, but from customer satisfaction and loyalty gradually eroding over years, making that customer base considerably more vulnerable the moment a sufficiently compelling alternative eventually does emerge. one offering enough of an improvement to finally justify enduring the switching cost. A genuinely durable switching cost moat, in his assessment, works best paired with continued investment in the underlying product itself, rather than serving as a substitute for that ongoing investment entirely. The fifth and final type is a price moat belonging to companies capable of consistently offering the lowest price in their entire category sustainably through genuine structural cost advantages that competitors simply cannot easily replicate, rather than through a temporary, unsustainable price war that would eventually bankrupt whichever company keeps it up the longest. Town emphasizes the word structural here quite deliberately, since a company that's merely willing, for a limited stretch of time, to sell below cost purely to undercut a rival doesn't actually have a genuine price moat at all. A genuine price moat comes from something durable underneath the low price itself: an unusually efficient supply chain, massive economies of scale a smaller rival simply cannot match, or some other structural cost advantage that allows the low price to remain profitable and sustainable indefinitely. Rather than merely as a temporary loss-generating tactic, he suggests a specific practical way of distinguishing a genuine structural price moat from a temporary unsustainable price war, checking whether the company maintaining the lowest price also maintains genuinely healthy, sustainable profit margins while doing so, rather than operating at a loss or at razor-thin margins purely to win a short-term battle for market share. A company genuinely profitable while also charging the lowest price in its category has almost certainly built some durable structural advantage underneath that price, exactly the kind of genuine price moat worth taking seriously as a durable, long-term competitive protection. He describes a specific illustration worth remembering, comparing two hypothetical competitors within the same industry, both currently offering similarly low prices to attract customers. The first maintains those low prices while still generating healthy, sustainable profit margins, evidence of some genuine structural cost advantage, perhaps superior logistics, superior scale, or superior operational efficiency built up over years. The second maintains similarly low prices while operating at a loss or at barely break-even margins, a pattern that simply cannot continue indefinitely without either raising prices eventually or exhausting whatever capital reserves are currently funding the unsustainable strategy. An investor mistaking the second company's temporary loss-funded low prices for a genuine price moat risks a rude awakening the moment that unsustainable strategy inevitably has to end. Town insists that identifying which of these 5 moats, if any, actually protects a specific business is one of the single most important steps in the entire evaluation process, because a business without any genuine moat at all, however impressive its current growth or current management team might look, remains fundamentally vulnerable to being copied, undercut, or displaced the moment a well-funded competitor decides to seriously compete for its customers. He devotes additional attention to a related important warning that even a genuine, currently durable moat isn't necessarily permanent, and that part of an ongoing investor's responsibility, even after a stock has already been purchased, is periodically reassessing whether that original moat still holds up as strongly as it did at the time of purchase. Technological change, shifting consumer preferences, and new regulatory developments can all, over time, erode even a genuinely strong moat that once seemed practically unassailable. Town describes watching entire industries transform within a matter of years. Moats that had protected certain kinds of businesses reliably for decades, suddenly rendered far less effective by a new technology nobody had seriously anticipated just a few years earlier. He suggests a specific, practical habit worth adopting for exactly this reason: revisiting the original moat evaluation for every holding at least once a year, asking honestly whether the same specific competitive advantage identified at the time of purchase still genuinely holds up as strongly as it did originally, or whether new competitors, new technologies, or shifting customer preferences have begun meaningfully eroding it. This ongoing vigilance, Town argues, is precisely what separates a genuinely disciplined long-term investor from someone who simply does careful research once, then holds indefinitely without ever revisiting whether the original thesis still genuinely holds true. The third M stands for management, and here Town introduces a specific quantifiable framework he calls the Big Five numbers, a set of 5 distinct financial metrics he believes taken together reveal an enormous amount about whether a company's leadership is genuinely skilled at creating durable compounding value for shareholders. Rather than simply managing a business competently in the ordinary sense, the first of these 5 numbers is return on invested capital, a measure of how efficiently a company's management actually converts the capital entrusted to them through both debt and equity into genuine additional profit. A consistently high return on invested capital suggests management genuinely knows how to deploy the company's resources productively rather than simply growing the business's overall size without a corresponding improvement in genuine profitability. Town treats this particular number as arguably the single most revealing of the 5, since it directly measures management's actual skill at capital allocation, distinct from simply benefiting from a favorably growing industry or a fortunate broader economic environment. He describes watching 2 superficially similar companies in the same industry growing their total revenue at nearly identical rates, while their return on invested capital told 2 entirely different stories, one steadily improving, the other quietly deteriorating, revealing a genuine difference in management quality that neither company's simple revenue growth figure taken alone would ever have exposed. An investor relying purely on top-line revenue growth without checking this specific measure of capital efficiency risks mistaking mere size for genuine, durable quality. The second number is sales growth, tracking how consistently and sustainably a company has been growing its overall revenue over an extended period, typically measured across the preceding decade. The third number is earnings per share growth, tracking how consistently a company's actual per-share profitability has grown over that same extended period, a distinct and arguably more important measure than sales growth alone, since a company can grow its total revenue while its per-share profitability stagnates or even declines, particularly if it's been issuing large numbers of new shares along the way. Town illustrates this specific distinction with a cautionary pattern he'd watched play out repeatedly. A company reporting impressively rising total revenue year after year, generating optimistic headlines, while its earnings per share, the actual measure that determines an individual shareholder's genuine slice of that growing pie, barely moved at all, or even quietly declined because the total number of outstanding shares had been steadily growing right alongside the revenue, diluting each individual shareholder's stake. An investor checking only total revenue growth without separately verifying earnings per share growth could easily mistake this kind of dilution-driven pattern for genuine healthy business growth, when the actual experience of an individual shareholder, measured in genuine per-share terms, told a considerably less flattering story. The fourth number is equity growth, sometimes described as book value growth, tracking how consistently the company's underlying net worth, its total assets minus its total liabilities, has grown on a per-share basis over the same extended period. Town explains why this specific number matters as an independent check, distinct from the earlier earnings-based measures. A company's reported earnings can, in certain circumstances, be shaped by accounting choices or temporary, one-time factors that don't necessarily reflect genuine, durable growth in the underlying value of the business. Book value, tracking the actual accumulated net worth sitting on the company's balance sheet, offers a somewhat different complementary lens, one less easily distorted by short-term earnings fluctuations, and one that over a genuinely long stretch of time tends to reflect whether a company's management has actually been building durable, accumulating value, rather than simply reporting impressive headline profit figures that don't necessarily translate into genuine underlying net worth. And the fifth number is free cash flow growth, tracking how consistently the actual cash a business generates, after accounting for the ongoing capital expenditures required to maintain and grow its operations, has grown over that same extended stretch of time. Town considers this final number in some ways the most difficult for a company's management to artificially manipulate or dress up favorably, since free cash flow reflects genuine cash actually moving through the business rather than an accounting figure subject to various legitimate but still somewhat flexible reporting choices. A company reporting consistently strong earnings growth paired with weak or stagnant free cash flow growth represents a specific worthwhile pattern to investigate further, since it can sometimes indicate that reported profits aren't translating cleanly into genuine, usable cash the business can actually deploy toward further growth, dividends, or debt reduction. Town's specific, memorable standard for all five of these numbers taken together is what he calls the 10 and 10 rule, looking for a minimum growth rate of roughly 10% annually, sustained consistently across a full decade for every single one of these five metrics. He's candid that very few real companies will ever satisfy this demanding standard perfectly across all five numbers simultaneously, and that finding companies clearing this bar even imperfectly narrows the entire universe of publicly traded companies down to a genuinely small, carefully curated shortlist worth investigating further in real depth. Let's walk through what this actually looks like, applied to a real evaluation, since the specific arithmetic helps make an otherwise abstract standard feel considerably more concrete. Imagine a company whose earnings per share grew from roughly $1 a decade ago to a little over $2.50 today. That trajectory represents almost exactly a 10% compound annual growth rate sustained across the full 10-year period, satisfying that specific piece of the standard cleanly. Town encourages running this same calculation independently across all five numbers, rather than assuming strong performance in one area. Say, impressive sales growth automatically implies similarly strong performance across the other four, since it's entirely possible for a company to grow its total revenue substantially while its per-share profitability, its return on invested capital, or its underlying book value all grow considerably more slowly or even shrink over that same period. He argues that this specific combination of numbers, examined together over a genuinely long stretch of time, rather than just a single strong recent year, does something a single glance at a stock's current price or its most recent quarterly earnings report simply cannot do. It reveals whether a company's management has demonstrated a consistent, sustained pattern of skillful capital allocation and genuine value creation across multiple different economic conditions and multiple different competitive challenges, rather than simply benefiting from one fortunate, temporary tailwind that happened to boost a single year's results. Town also addresses a specific, practical question new investors frequently raise: what to do about companies that satisfy four of the five numbers impressively, but fall meaningfully short on just one. He suggests treating this as a genuine yellow flag worth investigating directly, rather than either an automatic disqualification or something to simply overlook. The specific number falling short often points toward a specific identifiable weakness worth understanding clearly. Perhaps a company growing sales aggressively, while its return on invested capital quietly deteriorates, suggesting that growth is being purchased at the expense of genuine profitability, a pattern worth taking seriously before committing real capital. Regardless of how impressive the other four numbers happen to look in isolation, he walks through a second specific scenario worth understanding. A company showing strong, consistent growth across all five numbers for the first 8 or 9 years of the examined decade, followed by a sharp, sudden deterioration in the most recent 1 or 2 years. Town encourages treating this recent deterioration with real seriousness rather than dismissing it as a minor blip against an otherwise impressive longer-term average, since a recent sharp reversal often signals a genuine ongoing change in the business's competitive position or operating environment. One that a simple 10-year average calculated without attention to the specific year-by-year trend might otherwise obscure entirely. He recommends examining not just the overall decade-long average for each of the big five numbers, but also the specific year-by-year trajectory underlying that average, watching carefully for any recent acceleration or deceleration that might signal a genuine shift already underway, well before it fully shows up in the longer-term historical average. The fourth and final M stands for margin of safety, and this is where Town's framework moves from qualitative business evaluation into genuinely quantitative mathematical territory, calculating a specific price at which a given stock actually represents a sound, disciplined purchase, rather than simply an interesting company worth admiring from a distance. The core idea, borrowed directly from earlier value investing tradition, is straightforward in principle, even though the specific calculations involved take some real care to work through properly. Every business, Town argues, has some genuine, calculable intrinsic value, an estimate of what that business is actually worth based on its projected future cash flows and earnings, entirely separate from whatever price the stock market happens to be quoting for it on any particular day. The stock market's day-to-day price, driven by the shifting, often irrational moods of millions of individual participants, frequently diverges meaningfully from that underlying intrinsic value, sometimes trading well above it during periods of excessive optimism, sometimes trading well below it during periods of excessive pessimism or simple neglect. Town encourages calculating this intrinsic value using a specific method he calls the sticker price, a projection of what a company's earnings are likely to be worth a decade into the future, based on its historical growth rate and a reasonable conservative estimate of the valuation multiple the market is likely to assign to those future earnings, then discounting that future value back to a present-day equivalent using a specific required rate of return. Let's walk through a simplified version of this calculation to see how it actually works in practice. Suppose a company currently earns $2 per share and has demonstrated a genuine, sustainable 10% annual growth rate consistent with the Big Five standard discussed earlier. Projecting that same growth rate forward a full decade suggests earnings per share reaching somewhere in the neighborhood of $5 10 years from now. Applying a reasonable conservative valuation multiple to that future earnings figure produces an estimated future stock price. That future price then gets discounted back to today's dollars, using Town's own preferred required rate of return, producing the sticker price, an estimate of what the stock is genuinely worth today based on realistic assumptions about its future earnings power. Town explains the specific reasoning behind choosing that required rate of return deliberately high, considerably higher than the broader stock market's own long-term historical average return, rather than simply using whatever rate happens to be currently fashionable among conventional financial planning calculators. Setting a demanding required rate of return, he argues, serves the exact same protective purpose as the 50% margin of safety discount itself, ensuring that only genuinely exceptional opportunities capable of comfortably clearing an unusually high bar ever actually pass through the entire evaluation process at all. An investor using a considerably lower, more conventional required rate of return would find a great many more stocks technically satisfying the framework's mathematical threshold, but Town argues this would defeat much of the framework's entire protective purpose, diluting the demanding standard that makes rule number one genuinely meaningful in practice. Once that sticker price has been calculated, Town introduces the margin of safety itself, insisting on only actually purchasing a stock once its current market price has fallen to roughly half of that calculated sticker price, a deliberate, substantial discount he calls the MOS price, short for margin of safety price. This 50% discount isn't arbitrary. Town explains it exists specifically to protect an investor against the genuine uncertainty inherent in any forward-looking calculation. No projection of a company's future earnings, however carefully researched, can ever be perfectly accurate. Growth rates might slow, competitive conditions might shift, unexpected challenges might emerge. Building in this substantial discount, buying only when the market price sits meaningfully below even a conservative calculated value, creates a genuine buffer against the reasonable possibility that your own underlying analysis, however careful, still turns out to be somewhat too optimistic. Town describes a related alternative valuation method worth understanding alongside the sticker price calculation, something he calls payback time, borrowed loosely from a concept used in corporate capital budgeting, rather than projecting a future stock price and multiple years into the future. This method asks a more direct, intuitive question: roughly how many years of the company's own current and projected free cash flow would it take to fully recover the entire purchase price of the stock, assuming that cash flow continues growing at its own historical sustainable rate. Town suggests treating a payback period of roughly 8 years or less as a reasonable additional confirmation that a given price genuinely represents a sound, disciplined purchase, offering a second independent check against the sticker price calculation. Using a somewhat different set of underlying assumptions, he describes the specific appeal of this second method as its relative simplicity and its more intuitive, tangible framing compared to the somewhat more abstract sticker price calculation. Rather than projecting an entire future stock price a decade out, an investor using the payback time method simply asks how long in years it would genuinely take the business itself through its own growing cash generation to effectively pay back whatever price was paid for it. A business capable of paying back its own purchase price within 8 years or less, purely through its own growing free cash flow, represents, in Town's assessment, a genuinely attractive opportunity almost regardless of which specific valuation multiple the broader market happens to be assigning it at any given moment, since the underlying business itself is doing the heavy lifting of justifying the price rather than relying on some future hoped-for expansion in how generously the market chooses to value it. He recommends running both calculations independently on any stock seriously being considered, treating genuine agreement between the two methods, both suggesting an attractive price, as considerably more reassuring than either method used entirely in isolation, and treating meaningful disagreement between the two as a signal worth investigating further before committing any real capital. He describes a specific scenario illustrating why this cross-check matters. A stock whose sticker price calculation suggested an attractive margin of safety based on an optimistic assumption about continued strong growth over the coming decade, while its payback time calculation, relying more heavily on current, already demonstrated free cash flow rather than projected future growth, suggested a considerably less attractive picture. Town treats this kind of disagreement as a meaningful warning sign, suggesting the sticker price calculation may be leaning too heavily on optimistic assumptions about future growth that the company's current, already demonstrated cash generation doesn't yet fully support. In cases like this, he recommends erring toward the more conservative of the two figures, rather than simply accepting whichever calculation happens to produce the more attractive-looking result. This is, in many ways, rule number 1 made mathematically concrete. If a wonderful business satisfying all three of the earlier Ms. is purchased at a price already discounted substantially below its own conservatively calculated intrinsic value, the actual risk of a genuine, permanent loss shrinks considerably, even if the stock's price temporarily fluctuates in the meantime, precisely because the underlying business itself was never actually overpaid for in the first place. Town devotes a meaningful portion of the book to a question every investor eventually has to confront directly. Once they've actually purchased a stock satisfying all four Ms, when, if ever, should that position actually be sold? He offers a specific, structured answer built around 3 distinct scenarios, each representing a legitimate reason to exit a position, deliberately narrower than the far more common, purely emotional reasons most ordinary investors actually rely on when deciding to sell. The first legitimate reason to sell is discovering that the original evaluation was simply mistaken, that one or more of the 4 M's, on closer, more honest reflection, never actually held up the way the original analysis assumed. Perhaps the moat turns out to be considerably weaker than originally believed, eroding faster than expected under genuine competitive pressure. Perhaps the big 5 numbers, examined more carefully, reveal a pattern of deterioration the original quick analysis had missed. In this scenario, selling isn't really a market timing decision at all. It's simply correcting a genuine error in judgment, as promptly and honestly as possible, once that error has actually been recognized. Town describes a specific mistake from his own investing career that illustrates this exact scenario, admitting that early in his career he'd purchased a stock after what he later recognized as an insufficiently rigorous evaluation of its supposed moat. Having assumed a specific competitive advantage was considerably more durable than subsequent research eventually revealed it to actually be, rather than stubbornly holding the position purely to avoid admitting his own original mistake, he describes selling relatively promptly once the deeper, more careful research revealed the error, treating the resulting loss as a valuable, if uncomfortable, lesson in the genuine importance of thoroughness during the original evaluation rather than a reason to abandon the entire framework itself. The second legitimate reason to sell is a genuine fundamental change in the underlying business itself, a shift meaningful enough to actually break one or more of the original 4 M's that justified the purchase in the first place. Perhaps a company's moat, genuinely durable at the time of purchase, gets meaningfully eroded by a new technology or a well-funded new competitor. Perhaps management changes in a way that genuinely damages the company's historical pattern of skillful capital allocation. Town is careful to distinguish this kind of genuine structural change from the ordinary temporary noise every real business experiences: a single disappointing quarter, a short-term dip tied to broader economic conditions rather than any actual deterioration in the specific business itself. Selling in response to ordinary noise rather than genuine structural change is, in his assessment, one of the most common and most costly mistakes an otherwise disciplined investor can make. He offers a specific, practical test for distinguishing these 2 scenarios, suggesting an investor revisit their own original written business story, the same exercise recommended under the first M, and honestly ask whether that original story still holds up accurately against current reality. If the story remains essentially accurate, the company still doing fundamentally what it always did, still protected by essentially the same moat still run by management, demonstrating the same underlying skill, then a disappointing quarter or a broad market decline represents ordinary noise, not a genuine reason to sell. If the story itself no longer holds up, if the specific reasons the business once seemed excellent have genuinely changed, then Town considers that the clearest, most reliable signal that a genuine structural change has actually occurred, warranting serious reconsideration of the entire position. The third legitimate reason to sell is finding a genuinely superior opportunity, another stock satisfying all 4 M's even more compellingly than your current holding with a meaningfully more attractive margin of safety, such that reallocating capital from the current position toward the new one represents a clear, well-reasoned upgrade rather than simply chasing whatever happens to be currently exciting. What Town explicitly rejects as a legitimate reason to sell is perhaps even more instructive than what he accepts. He argues strongly against selling purely because a stock's price has risen substantially, arguing that a genuinely excellent business, still growing consistently according to its own historical Big Five pattern, will likely continue generating value for shareholders for years to come. Meaning an investor who sells purely because the price has already climbed considerably risks abandoning a great deal of the future growth that originally made the purchase worthwhile in the first place. He similarly rejects selling purely out of short-term market fear, arguing that a temporary, broad market decline absent any genuine change in the underlying business's own fundamental is precisely the kind of ordinary noise the entire margin of safety calculation was already designed to protect an investor against in the first place. He offers a specific, memorable illustration of this exact mistake, describing an investor who sold a genuinely excellent still-growing business purely because its price had already doubled from the original purchase price, reasoning that the easy gains had presumably already been captured and further growth seemed less likely. Town points out that this reasoning treats a stock's past price movement as though it were itself informative about future prospects, when the far more relevant question was always simply whether the underlying business evaluated fresh against the same 4Ms still genuinely satisfied the framework going forward. A business that has already doubled in price, while still growing its big five numbers consistently and still protected by the same durable moat, hasn't actually become a worse investment merely because its price has risen. It may, in fact, still represent exactly the kind of long-term compounding opportunity worth continuing to hold, regardless of how far it's already climbed from the original purchase price. Town devotes real attention to a related psychological concept borrowed directly from earlier value investing tradition, the idea of treating the overall stock market not as some wise, all-knowing oracle whose current price always reflects genuine underlying value, but as an unpredictable, emotionally erratic business partner sometimes described using the personification Mr. Market, who shows up every single day offering to buy or sell shares at whatever price his current mood happens to dictate. Some days Mr. Market arrives in a state of wild, unjustified enthusiasm, offering to buy your shares at an absurdly generous price. Other days he arrives in a state of genuine panic, offering to sell you shares at an absurdly cheap price, terrified by some piece of news that, on sober reflection, doesn't actually change the underlying business's genuine long-term value very much at all. Town describes this personification as more than just a memorable metaphor. It's a genuinely practical mental tool for separating the emotional pull of a fluctuating stock price from the more sober, disciplined question of what a business is actually worth. An investor who has internalized the Mr. Market framework doesn't feel obligated to react emotionally to a sudden price swing, the same way a sensible business partner wouldn't feel obligated to instantly match whatever mood their genuinely unpredictable, occasionally irrational co-owner happened to be in on any particular morning. The disciplined investor in this framework isn't obligated to transact with Mr. Market at all on any particular day, simply because he happens to be standing there offering a price. The disciplined investor waits, patiently, doing nothing at all during the vast majority of Mr. Market's daily visits, and only actually acts on the rare occasions when his offered price genuinely, substantially diverges from the calculated underlying value, either selling into his excessive, unjustified enthusiasm or buying into his excessive, unjustified panic. He offers a specific, illustrative account of applying this framework during a genuine period of severe market panic, describing watching stock prices across an entire sector collapse within a matter of weeks, driven almost entirely by broad, indiscriminate fear rather than any specific, individual deterioration in the underlying businesses themselves. Rather than joining that panic, Town describes returning to his own previously calculated sticker prices and margin of safety figures for several companies he'd already researched carefully in advance, and discovering that a handful of them had almost overnight fallen to prices genuinely below their own calculated Moss threshold, presenting exactly the kind of rare, fully qualifying opportunity the entire framework was designed to identify and act on decisively. He describes the specific emotional difficulty of actually acting decisively during that exact moment, admitting that even with the numbers clearly favoring action, the surrounding atmosphere of genuine fear and uncertainty made following through considerably harder than the calm, abstract logic of the framework might suggest from a comfortable distance. This is precisely why Town emphasizes having already done the research and calculations well in advance during calmer periods. Rather than attempting to research a company properly for the first time in the middle of a genuine panic, when clear thinking becomes considerably more difficult and the pressure to simply follow the panicked crowd grows considerably stronger. Town connects this directly to a specific, memorable metaphor borrowed from Buffett, comparing disciplined investing to a baseball hitter facing an unusual, uniquely generous rule, one where there's no penalty whatsoever for simply letting pitch after pitch go by without ever swinging. A batter facing ordinary baseball rules has to swing at reasonably good pitches or risk striking out entirely. An investor facing no such penalty for patience can simply wait calmly for a pitch landing precisely in their own personal sweet spot, a stock satisfying all four MZs simultaneously, trading at or below its calculated margin of safety price, and ignore every other pitch entirely, no matter how many tempting-looking opportunities pass by in the meantime without ever being acted on. This patience, Town argues, is one of the most underrated, underdeveloped skills in all of investing. Most ordinary investors feel a persistent, nagging pressure to be doing something, buying, selling, constantly adjusting their portfolio in response to whatever headline happens to be dominating the news that particular week. The genuinely disciplined rule number one investor, by contrast, might go weeks, months, or even considerably longer without finding a single stock that satisfies every part of the framework simultaneously and treats that extended patience not as a failure to act, but as the entire framework working exactly as intended. He describes this specific psychological challenge as, in many ways, considerably harder to master than the actual mathematics of the framework itself. Calculating a company's big five numbers, or working through a sticker price and margin of safety estimate, is a mechanical, learnable skill, one that becomes more comfortable and more efficient with repeated practice, sitting patiently on the sidelines, watching other investors chase whatever exciting story happens to be dominating financial media that particular month, resisting the very real, very human urge to simply do something rather than nothing requires a considerably deeper, more durable kind of discipline. One, Town suggests, takes years of deliberate practice to genuinely internalize. He offers a specific practical technique for building this patience, suggesting investors maintain an active, ongoing watch list of genuinely excellent businesses they've already researched thoroughly, complete with each one's calculated sticker price and margin of safety threshold checked periodically against current market prices. This transforms patience from a vague, difficult-to-sustain act of willpower into something considerably more concrete and manageable, a simple, mechanical process of checking a specific predetermined list against current prices, waiting calmly for the numbers themselves to eventually signal a genuine opportunity, rather than relying purely on raw discipline to resist whatever exciting story happens to be circulating at any given moment. Town addresses a further, closely related practical question many readers eventually raise: how many different positions a disciplined rule number one investor should actually hold at any given time. He argues against the kind of extreme, scattered diversification favored by some more conventional investing approaches, suggesting that genuinely deep, disciplined research of the kind this entire framework demands simply isn't practical to sustain across dozens of simultaneous holdings. Instead, he favors a considerably more concentrated portfolio built around a genuinely small number of businesses an investor has researched thoroughly enough to hold with real, well-earned conviction, rather than a large number of positions understood only shallowly. He's careful to balance this concentration against a genuine practical concern about risk, acknowledging that a portfolio concentrated too narrowly in too few positions leaves an investor genuinely vulnerable if even one of those positions turns out to have been fundamentally misjudged. Despite careful research, his own suggested balance sits somewhere between these two extremes, a portfolio built around a handful of carefully researched positions genuinely understood in depth, but still spread across enough different businesses and industries that a single mistaken evaluation can't devastate the entire portfolio at once. He suggests this specific balance point considerably more concentrated than conventional diversification advice typically recommends, but nowhere near as concentrated as betting everything on a single stock, reflects the genuine trade-off between the depth of research the framework demands and the basic protection against being catastrophically wrong about any single individual business. He offers a specific illustrative way of thinking about this balance, comparing it to the difference between a specialist surgeon and a general practitioner. A specialist who has trained deeply in a genuinely narrow area can perform that specific procedure with a level of skill and confidence a broadly trained generalist simply cannot match. But that same specialist would be considerably less equipped to handle an unfamiliar medical situation entirely outside their specific training. Town suggests an investor's portfolio should reflect a similar kind of disciplined specialization, genuinely deep expertise concentrated in a manageable, carefully chosen number of businesses rather than the shallow generalist familiarity that comes from spreading attention across dozens or hundreds of positions simultaneously. Town connects this specific balance directly back to rule number 1 itself. A portfolio spread too thinly across dozens of shallowly understood positions doesn't actually protect against permanent loss in any meaningful sense, since the investor genuinely lacks the deep understanding needed to distinguish a temporary ordinary decline from a permanent structural deterioration in any single one of those many positions. A portfolio concentrated appropriately in a genuinely manageable number of deeply understood businesses gives an investor the actual analytical foundation needed to make that crucial distinction confidently. Precisely the foundation rule number 1 depends on in practice. Town offers a further genuinely practical piece of guidance for anyone just beginning to apply this entire framework for the first time, encouraging new investors to practice the full process using a simulated paper trading account before ever committing real money to it. This allows a beginner to work through the actual mechanics of researching a business, evaluating its moat, calculating its big 5 numbers, and estimating its sticker and margin of safety prices, making the inevitable early mistakes and refining their own analytical judgment, entirely without financial consequence before ever risking genuine capital on a real live decision. He describes this practice period as considerably more valuable than most impatient beginners initially assume, precisely because the specific skill of correctly estimating a company's future growth rate and correctly judging the genuine durability of its competitive moat takes real, repeated practice to develop reliably in exactly the same way any other complex judgment-dependent skill does. An investor who skips this practice period entirely, jumping straight into real, live decisions with genuine money on the line, is considerably more likely to make costly, avoidable mistakes during the exact period when their own analytical judgment is still at its least reliable and least refined. He suggests a specific structured way of using this practice period, effectively recommending that beginners work through the complete 4M evaluation on at least 5 to 10 different companies before ever placing a single real trade, deliberately choosing a mix of businesses across different industries and different moat types so that the beginner's own analytical instincts get tested against a genuinely varied set of real-world scenarios rather than becoming narrowly calibrated to just one familiar type of business. He also recommends keeping a written record of each practice evaluation, including the specific reasoning behind every Big Five calculation and every sticker price estimate, so that a beginner can later compare their own initial projections against how the actual business subsequently performed, building genuine evidence-based confidence in their own judgment over time, rather than simply assuming their analytical skills are sound without ever actually checking that assumption against real outcomes. He offers a specific additional suggestion for structuring this practice period, even more usefully recommending that beginners deliberately include at least 1 or 2 practice evaluations of companies they ultimately conclude do not satisfy the framework, rather than only practicing on companies that seem obviously promising from the outset. Learning to recognize and clearly articulate exactly why a given business fails one or more of the 4 Ms Town argued builds a genuinely different and equally valuable skill compared to simply learning to recognize success, one that considerably sharpens an investor's overall judgment and makes genuine opportunities, when they eventually do appear, considerably easier to distinguish confidently from the much larger number of businesses that don't actually qualify. There's a specific psychological benefit to this practice period. Town emphasizes repeatedly, beyond simply the technical skill building itself. A beginner who has already worked through dozens of practice evaluations, watched some practice picks perform well and others perform poorly, and refined their own process along the way, arrives at their first real live investment decision with considerably more genuine confidence and considerably less raw anxiety than someone attempting the entire framework for the very first time with real money already on the line. That reduced anxiety, in turn, makes it considerably easier to actually stick with the framework's demanding patience requirement, rather than abandoning it under emotional pressure the very first time a real position experiences an uncomfortable temporary decline. Town also spends real time addressing a specific common objection to this entire framework, the concern that requiring a stock to satisfy all 4 Ms simultaneously and to trade at such a substantial discount to its calculated intrinsic value will leave an investor with almost nothing to actually buy during most ordinary market conditions. He acknowledges this concern directly and honestly, agreeing that genuine, fully qualifying opportunities are, by design, relatively rare, particularly during periods of broad market enthusiasm when most stocks trade at valuations considerably above any reasonable calculated margin of safety. But he argues this scarcity isn't actually a flaw in the framework. It's the entire framework working exactly as intended, deliberately filtering out the overwhelming majority of available stocks, precisely because the overwhelming majority of available stocks at any given moment genuinely don't represent a sufficiently safe, sufficiently well-understood opportunity to justify committing real capital toward Town. Encourages patient investors to view periods of genuine market panic and broad pessimism, precisely the moments when most ordinary investors feel most reluctant to buy anything at all, as the periods when the framework is most likely to actually surface genuine, fully qualifying opportunities. Since widespread fear tends to push even genuinely excellent businesses down to prices trading well below their own calculated intrinsic value. He describes a related practical reassurance worth offering to anyone feeling discouraged by how demanding this entire framework can seem, particularly during long stretches when a diligent, well-maintained watch list produces no genuinely qualifying opportunities at all. Town points out that the entire goal was never to be constantly actively invested in as many positions as possible. It was to be invested only in the small handful of genuinely excellent opportunities that actually satisfy every part of a disciplined, carefully constructed framework. Even if that means holding a meaningful amount of cash on the sidelines for extended stretches, waiting patiently for the next genuine pitch to arrive squarely within the strike zone. He addresses a further related concern some readers raise, worrying that holding significant cash on the sidelines during a strong bull market means missing out on considerable gains other, less disciplined investors are currently enjoying. Town's response draws directly on rule number 1 itself, arguing that the specific investors most likely to be caught off guard by an eventual inevitable market correction are precisely the ones who felt compelled to stay fully invested throughout every single market condition purely to avoid the uncomfortable feeling of missing out on a rising market. The disciplined investor, holding cash and waiting for genuine, fully qualifying opportunities, isn't missing out in any meaningful sense at all. They're simply declining to participate in exactly the kind of speculative, overpriced buying that tends to produce the largest, most painful losses whenever that inevitable correction eventually arrives. There's a further dimension to this patience worth understanding clearly, one that connects directly back to Town's own personal story on the river. His mentor never promised him instant, effortless wealth. What he promised, and what Town's own subsequent 5-year track record eventually demonstrated, was that a disciplined, patient process applied consistently over a meaningful stretch of time could produce genuinely extraordinary results precisely because it avoided the catastrophic, account-destroying mistakes that derail so many otherwise intelligent, well-intentioned investors along the way. The framework wasn't fast. It was reliable. And Town argues that reliability, compounded patiently over years rather than weeks, is where genuine, durable wealth actually gets built. It's worth pausing here on a fair, honest criticism, worth naming directly, one occasionally raised by readers and other investing writers, examining Town's framework closely, the specific numeric standards at the heart of the Big Five numbers, and the margin of safety calculation, however clearly articulated, still depend heavily on an individual investor's own subjective judgment when actually applied, particularly the specific growth rate and valuation multiple projected forward a full decade into the future. 2 equally careful, equally well-intentioned investors applying the exact same framework to the exact same company could reasonably arrive at meaningfully different sticker price estimates simply because their own individual assumptions about future growth and future valuation multiples genuinely differed. Town himself acknowledges this inherent subjectivity in places throughout the book, which is precisely part of why he insists so strongly on the 50% margin of safety discount in the first place, treating it explicitly as a deliberate buffer against exactly this kind of reasonable estimation error, rather than assuming any single calculation could ever be perfectly objectively precise. The framework was never designed to eliminate judgment from investing entirely. It was designed to structure that judgment carefully, forcing an investor to make their assumptions explicit and testable, rather than relying on vague, unexamined intuition alone, while building in enough of a safety buffer that even a somewhat overly optimistic set of assumptions still leaves meaningful room for error before an investor's actual capital is genuinely at risk. He offers a related practical piece of reassurance for investors worried about getting these specific numbers exactly right on their very first attempt, encouraging a habit of deliberately running the same calculation multiple times, using a range of reasonably conservative assumptions, rather than committing to a single precise-sounding number. An investor calculating a sticker price using a deliberately conservative growth rate estimate and separately checking that same calculation against an even more conservative, more pessimistic estimate gains a considerably more honest, more useful sense of the genuine range of reasonable outcomes than a single falsely precise number ever could provide on its own. He extends this specific habit into a broader, practical piece of advice, worth carrying into every part of the framework, not just the valuation calculations. Whenever a specific input, a growth rate, assumption, an estimate of moat durability, a judgment about management quality involves genuine subjective uncertainty, Town recommends deliberately testing that judgment against both an optimistic and a pessimistic version, checking whether the overall conclusion buy or don't buy actually changes meaningfully, depending on which end of that reasonable range is used. An investment thesis that only holds up under the most optimistic possible assumptions and falls apart entirely under more conservative ones represents a considerably shakier foundation than a thesis that remains sound across a genuinely wide range of reasonable assumptions, precisely the kind of robustness Town encourages every investor to actively test for before committing real capital. If any of this resonated with you, the full narration series continues on the Money Files audiobooks channel, where books exactly like this one get broken down in this same long-form, deep-dive style perfect company for a long commute, a quiet workout, or simply falling asleep to something that might genuinely leave you thinking differently about what it actually means to invest with real disciplined skill rather than hope alone. If you're wondering what any of this actually looks like translated into something you could genuinely start this week, Town's own framework, however demanding it might sound, laid out in full scales, down to a fairly manageable weekly practice once broken into its component pieces. Pick one company you already have some genuine first-hand familiarity with, ideally something satisfying that first M, genuine personal meaning and understanding, rather than an unfamiliar name pulled at random from a stock screener. Spend an evening researching which of the 5 moat types, if any, genuinely protects that business from easy competition, being honest with yourself if the answer turns out to be none at all. Pull up the company's historical financial statements and calculate its big 5 numbers across the preceding decade, checking each one independently against the 10 and 10 standard, rather than assuming strong performance in one area implies similarly strong performance everywhere else. And finally, work through a rough sticker price and margin of safety calculation, comparing that figure honestly against the stock's current market price, and noting, without any pressure to act immediately, exactly how far the current price sits from that calculated threshold. It's worth being honest that this entire process, worked through carefully for even a single company, genuinely takes real time and sustained attention, considerably more than glancing at a stock's recent price chart or reading a single analyst's confident recommendation. Town would argue that this additional time investment is exactly the point. An investor unwilling to invest a genuine evening of focused research into a single potential holding is almost by definition not yet applying the discipline the entire framework depends on, and would likely be better served, at least initially, sticking to a small number of carefully chosen practice evaluations before ever committing real capital to a live decision at all. He offers one final practical piece of encouragement worth carrying forward, aimed specifically at anyone feeling genuinely intimidated by the sheer scope of this entire framework laid out in full. Nobody, including Town himself during his own earliest years, masters all 4 Ms perfectly on their very first attempt. The specific skill of correctly identifying a durable moat or confidently calculating a reasonable sticker price genuinely improves with sustained, deliberate practice in exactly the same way any other complex skill does. What matters most, at the very beginning, isn't achieving perfect precision on the first try. It's building the consistent habit of actually running every potential investment through this same disciplined 4-part process patiently, allowing genuine skill and confidence to accumulate gradually over months and years of continued practice, rather than expecting instant mastery from a single afternoon's effort. You likely won't find a stock genuinely satisfying every single part of this framework on your very first attempt, and that's entirely expected. Precisely the reason Town encourages building a genuine ongoing watch list rather than expecting instant results. What matters isn't finding a perfect opportunity this particular week. What matters is building the habit of running every potential investment through this same disciplined 4-part process consistently, so that when a genuine opportunity eventually does arrive, trading at a real discount to a carefully calculated value, you're actually equipped to recognize it clearly and act on it with genuine, well-earned conviction. There's a specific kind of confidence that comes from actually working through this entire process yourself, start to finish, rather than simply trusting someone else's confident-sounding recommendation. An investor who has genuinely written out a business's story, identified its specific moat, calculated its big five numbers, and worked through both a sticker price and a payback time estimate, arrives at their eventual decision with a fundamentally different kind of understanding than someone who bought purely because a friend, an analyst, or an exciting headline suggested the stock looked promising. That deeper understanding is precisely what allows an investor to hold steady through the inevitable ordinary turbulence every real business experiences, distinguishing genuine, thesis-breaking trouble from simple temporary noise that shouldn't change anything at all. The next time you find yourself tempted by an exciting stock tip or a headline promising the next big opportunity, you might find yourself running through a simple four-part question instead of reacting immediately. Does this business genuinely have meaning to you? Does it have a real, durable moat protecting it from easy competition? Has its management demonstrated a consistent, decade-long track record of genuine skill? And is its current price actually offering you a genuine margin of safety, rather than simply asking you to hope the story keeps working out? Because the entire point of rule number 1 was never really about avoiding every single temporary loss. It was about building a disciplined enough process that the far more dangerous kind of loss, the permanent, unrecoverable kind, simply never gets the chance to happen in the first place. Somewhere on a stretch of whitewater decades ago, a broke young river guide with exactly $1,000 to his name learned a lesson that would eventually be worth considerably more than any single rapid he ever navigated professionally. The lesson was never really about getting rich quickly. It was about learning to see, clearly and patiently, the difference between a genuine opportunity and an exciting story dressed up as one, and having the discipline to wait calmly for the difference between the two to actually reveal itself.